If you've ever felt that pit in your stomach trying to figure out the perfect time to invest, it feels like a total roller coaster. So today, we're going to break down a really powerful strategy that's designed to smooth out that ride. It's called dollar cost averaging. Let's jump in. All right, so here's our game plan. First, we'll talk about that investing roller coaster. You know the feeling. Then we'll introduce a much simpler way, DCA. We'll get into how it actually works, put it to the test with a real example, help you figure out if it's the right move for you, and then wrap it all up with the one big takeaway for your own investing journey. So yeah, let's start right there with a feeling that just about every investor knows way too well, the sheer stress of trying to perfectly time the market. Right? I mean, it's this constant nagging pressure to somehow predict the future. Should I buy right now before the price shoots up? Oh wait, should I sell before it all comes crashing down? The truth is, even the most seasoned pros get this wrong all the time. And honestly, this is the real trap. When we try to outsmart the market, we almost always end up making decisions based on emotion. We get that fear of missing out, so we buy when prices are already sky high. Or we panic and sell everything when things look a little shaky. That is exactly the kind of emotional investing that can seriously hurt you in the long run. But what if there was a way to just take all of that emotion out of the equation? Well, guess what? There is. And it's a strategy that's built on two simple things: consistency and discipline. It's called dollar cost averaging, or DCA for short. Okay, so what is it exactly? Well, the definition is actually beautifully simple. With DCA, you invest a fixed amount of money, let's say $100, on a regular schedule, like every single month. And you do it no matter what the market's up to. The price could be soaring, it could be dipping, doesn't matter. Your investment amount stays the same. It is all about that consistency. Now, this is really key to understanding the whole philosophy here. DCA is not some get-rich-quick scheme. Its main job, its whole purpose, is to help you manage risk. It keeps you from, throwing a huge chunk of cash into the market at the absolute worst time, like right at a peak. So we know what it is, but let's get into the nitty-gritty of how this strategy actually works in the real world. And it really is as easy as 1, 2, 3. First, you just pick a dollar amount you're comfortable with. Could be $50, could be $200. Second, you set a regular schedule, maybe every Friday or the day you get paid. And third, and this is the most important part, you automate it and you stick to it. You invest that amount on that day without fail and without second guessing. If this whole thing sounds kind of familiar, it's probably because a lot of us are already doing it without even thinking about it. Your 401k is the perfect example. A little bit of every paycheck gets invested automatically. And this shows you the real magic of DCA. That fixed amount of money naturally buys you more shares when the price is low and fewer shares when the price is high. It's automatic. And hey, here's a little fun fact for you. Another name for this whole strategy is the constant dollar plan, which, that pretty much perfectly describes what you're doing, right? Investing the same amount of money each time. All right, theory is great and all, but let's see how this actually plays out with some real numbers. It's time to put DCA to the test. Okay, so let's meet Jordan. Jordan's decided to invest $50 into an S&P 500 fund every single payday. As you can see, the share price is all over the place. Sometimes it's up, sometimes it's down. But look closely. When the price dips to $9.50 in period 2, Jordan's $50 buys more shares. But when the price jumps to its highest point of $11.50 in period 9, that same $50 buys fewer shares. See how that works? And this right here is the aha moment. By using DCA, Jordan invested $500 total and ended up with almost 48 shares. That means their average cost per share was just $10.48. Now, let's compare that. What if Jordan had tried to time the market and dumped the whole $500 in at once, maybe during period 4 when the price was $11? Well, they would have ended up with fewer shares. The bottom line is crystal clear. DCA got them more shares for a lower average price. So this little example just perfectly spells out all the benefits, right? It lowered the average cost. It completely removed the emotion and the guesswork from the decision. It prevented Jordan from putting all their money in at a high point. And maybe best of all, it built this fantastic, powerful habit of investing consistently. Okay, so this strategy is looking pretty powerful, but let's be real. Is it the perfect fit for everybody in every single situation? Let's take a good, honest look at that. DCA is an absolute game changer for a couple of groups. If you're just starting out, it's an amazing way to get your feet wet without all that stress of trying to time things perfectly. And it's also ideal for long-term investors who just want to steadily build their wealth, but don't have the time or the desire to be glued to market charts all day.
The market conditions definitely matter too. Like we just saw in our example, DCA really shines in choppy, volatile markets where prices are going up and down. That's how you get the benefit of buying at all those different price points. Now, the flip side is that in a market that's just going straight up nonstop, historically, a big one-time investment right at the beginning would have actually done better. That's kind of the trade-off with DCA. You might miss out on some gains if the market never really takes a breather.
And listen, this is a really, really important point to make. Using DCA for something like a broad S&P 500 index fund is generally less risky because you're automatically diversified across hundreds of companies. But using it for one single stock, that's a different story. If that one company starts to fail, DCA just means you're automatically buying more and more shares of a sinking ship. So please always do your homework on individual stocks. Okay, let's pull all of this together and really focus on the main takeaway, the thing you can start applying to your own finances. So if there's only one thing you remember from all of this, let it be this: you cannot control the market. You just can't. But what you can control are your own actions. DCA is a strategy that puts all the focus on the one thing that's actually in your power: your own discipline and your own consistency. And you can put this principle to work all over the place. Set up automatic investments into ETFs you like. Make those regular contributions to your IRA. Even use it to slowly build a position in a company you really believe in for the long haul. It doesn't matter what you're buying. The engine that makes this strategy go is just one thing: consistency. And that leaves us with one final thought to chew on. We spend so much time and energy trying to guess the perfect moment to jump in. But what if the real power isn't in timing the market at all? What if it's all about the time you spend in the market, driven by simple, powerful consistency? Something to think about. Thanks for tuning in.